All right, now the two examples I'm going to show you, one is the German Bund, one is the EuroStoxx50, and then the one that is now effectively in play, in other words, it's done this part, is the Euro-Dollar FX. So beautifully, you can apply the strategy anywhere, right? It doesn't have to just be in traditional markets. It can get applied in any market. Why? Because the strategy is not created by a name. It's created by the principles that create that strategy. In other words, the principles in this is we get initiative, we get the grinding bounce. Once the sellers step back in and the market shows us structure, we enter and execute. Okay, with that in mind, let's get to the first example. So the first one I want to talk about is the, I might as well start with the Bund. We've got it. And again, time frame, guys. It can be on any time frame. This is a daily chart in the Bunds. Okay, it can be on any time frame. It doesn't have to be on a lower time frame. All right. What I would say is that technically, initiative is something you tend to see on slightly longer time frames. In other words, daily, maybe 60-minute, maybe 4-hour. Okay, so I would not be applying the strategy to 1 minute, 5 minute, all that sort of thing. Right? It works better when we have initiative, and we don't tend to get initiative on shorter term time frames. It tends to come over a longer time. Why? Well, think about it. Do you think Goldman Sachs is just going to execute for 2 minutes? No. Okay, Goldman Sachs will execute over the period of a morning, a period of a couple of weeks, a period of a couple of months. Okay, so what we've got is a daily Bund. Note the initiative. Now, importantly, remember what I said. Number one, we need initiative, and we can see that with volume and what? Range expansion. That's rule number one. We need to see that initiative in the market because that initiative tells us there's big time frame players in the market. Rule number two, we want to see a grinding type bounce. And once the market grinds and bounces, all right, we want to see low volume accompanied with it. So we can see in this element the nice grindy bounce. Okay, and note what the volume's doing. The relative volume is almost 50% of what we saw on the initiative down move. Okay, now note what we did in 1, 2, 3, almost, call it 8 days. So the down move was 8 days, and then the grinding move lasted almost 15 days, so almost double the time period. Okay, so now what you've got to say to yourself is, at which point are we getting involved in this dead cat bounce? Now, what we're not doing, and this is the danger, this is the mistake people make, people always want to sell it on the way up. They always want to pick the perfect price entry. You do not need to pick the perfect price entry. Right? What you need to do is allow the market to create enough structure, and I'll show you an example of structure, create enough structure so that once that structure breaks, it brings in the initiative and the volume again. It's that a second round of initiative and volume that's going to give you the move back towards the extreme and ultimately kill that dead cat, properly dead. Okay, so that's the example, and you'll see in this example for structure, what I've gone and leaned on was a trend line. So you can see we drew this trend line here. Now, very interestingly, if you go and have a look at this was back early in the year, you'll notice that once we took out this daily low, okay, if you go look at it on a 60-minute chart, it really had a really strong one-time framing down move the entire session. Okay, so really, really strong structure in the market. Now, what this dead cat bounce did not do is it did not resolve itself all the way to the low. Okay, ultimately what happened was that sell day that we had there, right, we had a very aggressive down move. It ran into some extremely strong buyers, and we actually reversed the entire move. Okay. So again, this is why it's so important to obey the risk, because you would have lost relatively little on this daytime, right? Once you're in, once the market gives you the structure, you're trailing the stop, you're managing the risk. So at worst case scenario, you wouldn't have lost anything on this dead cat bounce, okay? Because why? And this is the mistake traders make. If we know that a dead cat bounce, once it bounces, the strategy is to turn and at least retest the previous extreme. If we know that's the play, once we are in play, so once we execute on the way down and we're in play, if the market is failing to do what we think it should do, which is a straight line down move or an initiative down move towards the previous extreme, if it doesn't do that, then we need to start being a little bit more wary about the ultimate pattern. Okay, so that's one example. Now, it's good that we both, this is the important thing about any strategy, guys. Remember, it is a strategy. It fails sometimes. Okay, in this example in the Bund, it failed, right? The risk here was you lost a couple of ticks, but you exposed yourself to a potentially very good move over a couple of days. All right, now let's look at the second example we've got. So the second example is one that we saw in the EuroStoxx 50, which played out a little bit better.